All right, my name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk about the debate of owning a home versus renting a home. So I've been consuming a bit of content regarding this lately. The guy's name, Ramit, I believe is his name, has a Netflix show, Get Rich show. But his big claim to fame, or the big thing he talks about, is, hey, don't buy a home. And I think the thing he is referring more so to buy a home as far as being in a primary home. I don't think he's referring to investing in real estate. I've never watched his just clips and snippets of it. And even before him, I would consume content online about the whole buying versus renting thing. You always hear about the different viewpoints, but one thing I never hear about it, and it does add an interesting wrinkle dynamic to the debate. I wanted to talk about it from a standpoint of a business owner, because I think the dynamics and the calculus proves to be a little different for one that might not be a business owner. I just think that calculus is a little different for those that are self-employed. It breaks down to two different components. One is factoring in cash flow as someone that's self-employed, and the other is the deductibility of your home expenses. So touch on the first point with cash flow. As a business owner, cash flow is very important. You don't have cash flow, you're not in business. So one thing to consider when looking at renting a home versus buying a home, and again, we're looking just at your primary residence. So we're not getting into or debating about investing in real estate. This is strictly for where you and your family rest your head at night. I do want to preface everything I'm saying with that. But from a cash flow perspective, you got to have active cash flow to sustain your business. One thing I prefer about renting, I'm a renter myself, is that it's always predictable cash flow. I like to have predictable cash flow coming in and going out. So as a renter, you're able to, at least on that one side of the equation, have predictable cash flow going out. You know that on your housing, you can predict a lot easier what your housing expense is going to be. Part of the cost of owning a home is that you obviously have to have maintenance, and many times you don't know when you need to do it. Something breaks down, something needs to be replaced. So a lot of times you don't plan for those things. They just happen. The item breaks or you realize it, and you can't predict it to be a quick, cheap fix or expensive things. From a standpoint of predictability, it can throw your cash flow out of whack. As you know, again, that doesn't necessarily mean your costs are going to stay the same. Your pricing and costs will tend to increase, obviously, with rents that go up from time to time. And one thing that one can do to help predict, or at least to help control the inflationary rates, to control your rent expenses, is negotiate your rents a couple of years at a time. So you get a chance to lock in a specific rate and know that you have it for a couple of years. Now, a savvy landlord may turn around and essentially just raise it to what it would be the next 2 years later, so that they don't necessarily skip a beat. But nonetheless, during that time of the lease, you know that it's state, right? Again, predictability of cash outflows. So there's also the premise that you're building your business over that time too. So the idea is that by the time the increase hits, you or your business should be in a better position to handle that increase in outflows. That's one factor to consider. And with having the predictability of cash outflows, that also gives you an opportunity to put more money into your business and grow. So you have the growth mindset. The idea is that you're continuing to put money into your business to grow and to take it to the next level. So that cash is serving as your fuel. So the idea is that money you're putting into your business to grow should be yielding you a much better return than any appreciation on the home. If it's not, then you may have an issue there. But I mean, I think outside the anomaly of what happened during the pandemic where prices shot up, that's normally not going to happen. So the premise is that the money that you put into your business should outpace any appreciation. So again, renting allows you the predictability of cash flows to be able to comfortably do that, versus if you may own, then you got to have money aside to take care of whatever maintenance issues come up, and hopefully they're not major, right? So I think that's one thing you need to consider. The other thing to consider are the tax implications, right? So as a self-employed individual, you do get deductions for your home office. So even if you have a place of business outside of your home, I usually encourage my clients to do the home office deduction, mainly because there's probably a good chance you're doing some sort of work at home. So even if you have your own office, more than likely you're doing some sort of admin work at home, whether that be paying some bills, doing your books, a lot of admin things that if you're self-employed, you're doing that at home. So if you have a space in your home to do this, you're pretty much eligible to take the home office deduction. So that allows you to that deduction on your taxes. You also have to look at it and say, okay, with this deduction, you are reducing your taxable income, right? So there's the benefit of taking a deduction. Now, there's two methods of going about doing this thing. So if you rent, assuming a Schedule C, and this is if you're a single member owner LLC, you're doing everything on a Schedule C personal return. So two ways to do it. If you rent, you're simply taking a portion of the home that's considered your office, take that percentage based upon the square footage, technically speaking, 8 to maybe 20% of the home. Typically, let's say if you have an apartment and you have a room, maybe use a room in your apartment or home, take that percentage overall, and then you go ahead and make that deduction. So if 15 of my square footage is used as my home office, I can take 15%. So it's pretty cut and dry. A little different with all the rest of my expenses. So my utilities, my renter's insurance, if I'm at that 15%, I can just take the 15%. Now, if you're a homeowner with homeownership, you don't necessarily take your mortgage payment and just write off that same 15%. You can still take that same percentage with your utilities, your home insurance, if you own. The difference between owning and renting is how you treat the mortgage payment. So the mortgage payment is normally broken up into your interest and your principal. So you would apply the interest portion of that payment, but your payment has two components, right? Interest and principal. So the interest portion, you can apply that percentage. Now, the rest that is the principal, that's where the depreciation comes in. And this is where things get interesting with the depreciation, because you have to write that off over the course of 37 years, which is the principal, which is really the cost of the home. So take what you pay for the home, split it up into 37 years, and 37, 37 and a half, 39 years, but somewhere in that ballpark, you get the point. So to keep things simple, so if you have a $300,000 home, that 300,000, and again, it's at that 15%. So if we still had the 15% that you were using, it's 15% of the 300,000, right? So what is that? Roughly 45,000, right? So you can deduct $45,000 over the course of 37 and a half years. That's a long time to do. And more than likely won't be in a home for 37 and a half years. So you probably won't get a chance to ever really see that full benefit. So that's actually more of a con. Say pros and cons, it's probably a con of owning, because that deduction is a lot slower, right? Versus with rent, it's 15%, whatever I'm paying, 15%. I can write that off. And then the other kicker is that as a owner, that 30,000 that I said that you were going to be, or the 45,000 that you're writing off for the course of that 37 years, if you go and you sell the home, you actually got to pay the tax back, which is called depreciation recapture. So nonetheless, if you have a home office and you own, you get that depreciation and say everything is great, but you essentially have to pay it back. So you're kicking the can down the road, so to speak. Where with rent, you take that 15%, you leave the rental, you never have to worry about it again. So kind of works in your favor when you're renting in that case. Now, there is one way around all this. So if you are in your home, don't fret, don't move because of this, but there's one way around it. And that's if you tax yourself as a corporation. I had mentioned that if you're a Schedule C owner, same thing if you're a partner in a partnership, everything I just said applies. One way around all of this is that if you're set up as a corporation, S or a C, the write-off gets a lot simpler if you're set up this way. And even if you own the home, you can avoid depreciation recapture, and you can also accelerate your deductions a lot quicker if you're set up as this corporation. So that's through what's called an accountable plan, where as an employee of your corporation, and let's say you own all the shares, 100% owner, the corporation is treated as a separate entity from you as the person. So more than likely your home is in your name, and not your corporation's name. So what you can do is you can have your corporation reimburse you for use of your home. Now, the beautiful thing about this and why I love implementing this strategy is that your corporation can reimburse you for use of your home. Now, as a reimbursement, and you taking a reimbursement as an employee, tax free to you. So if you've ever worked anywhere as an employee and you submit your expenses and they pay you back for it, that's not taxable income when your employer pays you back for your expenses. Concept here, except that you're both the employer and the employee, right? So you as the employer can set what that reimbursement rate is going to be to yourself as the employee. And this is something that I love implementing all the time because you can have free reign. You want to do it within reason, but you can have free reign as far as what that reimbursement will be. So if I'm paying $3,000 in rent and I decide that my reimbursement rate is going to be $2,000 a month, you get a deduction of $2,000 a month on your rent. The whole percentages game doesn't really matter, right? So even if you only use 15% of your home for your office, you don't have to worry about the percentage. Now, I would advise you probably want to keep this within reason, because if you were to get audited, someone would say, is this a normal market rent? But, it does allow a good amount of leeway. You don't have to worry too much about the percentages, but you don't want to go overboard, right? You don't want to say that your home office was a corner and you're charging $10,000 a month for rent. So you don't want to go over, but it gives you a lot of flexibility as far as determining what you can have as that reimbursement rate. And it could be a beautiful thing because you get the deduction on your personal taxes or your corporate taxes, whichever ones you want. It defrays the cost of your ownership, right? So if your rent is $3,000 and you are doing a reimbursement of $2,000, if your tax rate is 25%, you get a deduction of $500. So you're essentially saving $500 a month in taxes, and that's real money. So you can also look at it and say, then that $3,000, it's $2,500 in rent, because your tax savings is actually that when you take the 500 to offset, then your rent is really $2,500 from a net cash outflow based upon the taxes that you're saving from your business and what the outflow is. So it's quite important to take a look at and keep in mind, as self-employed individuals, you're paying with pre-tax dollars, right? Most folks, when I hear the argument, paying with after-tax dollars, right? As self-employed folks, you decide what you want to pay in taxes and when. Because you're doing this with pre-tax dollars, not after-tax dollars, that creates even a larger savings. So if you are self-employed, these are the things that you want to take into account and factor in. Now, I also ultimately tell my clients, so you have to factor in lifestyle stability. I understand that many folks have families, you have kids. I can also understand the value in wanting to have somewhere stable and not necessarily tied up and moving all around. So there are values associated with that don't necessarily have a dollar sign attached to it. So the decision isn't 100% tied to just dollars and cents things. Sometimes it might just be, peace of mind, as that can be worth more than anything money can buy. So you have to take that into account as well. Well-being and mental health of you and your family. So that may come into the calculus as well. And again, sometimes you can't put a dollar amount on well-being, but just some things to think about and consider as a business owner when doing the buy versus rent analysis. So that's all for now. I hope this was helpful. If you have any more questions about this topic or any other tax or accounting related issues, feel free to reach out. I'm happy to help. All right. That's all for now. I'll talk to you in the next one.